the tax regime for offshore investment funds. Sometime earlier during the last either this week or early last week, we saw that what the government intended to do with International Financial Services Center. So where a lot of tax incentives were given for entities which were listed out of an IFSC or for opening bank accounts in an IFSC, the government treated that as typically being outside India. Similarly, offshore investment fund. So before we get into the technicality, let's try and understand at the highest level what an offshore investment fund is. An offshore investment fund typically refers to the word offshore is obviously overseas or it's not part of a sovereign territory. And the main purpose is to route investments. Classic example, $350 billion of FPI in India comes via, $50 billion of FPI in India comes via 350 offshore investment funds located. So, elsewhere, it could be Mauritius, it could be Singapore, it could be Ireland. And so the government also of the day felt that India should have its own offshore regime, which is why the IFSC piece came into picture. So, with this prelude, let's quickly now move on to try and understand how this works. I would like to thank Thirumal and Jugal for their efforts to get the presentation done. These are some of the terms which we would be using in this. AUM is assets under management, FPI is foreign portfolio investment, and I guess rest of it is fairly what we've used otherwise. Fairly elaborate presentation agenda, friends, over the next 15-20 minutes. What is the scenario here? What are the conditions when a fund manager would be deemed as not operating out of India? And what is the scope for the asset management industry? We will also do a quick deep dive into the high level advisory committee report, Surjit Balla committee report. They've given some very pertinent recommendations, and of course, see what the way forward is. Now, the government, as we discussed, wanted to move all the offshore funds, especially if you look at the India focused offshore funds, to India. So, which is why they said they introduced Section 9A of the Act, according to which if certain eligibility criterions are being satisfied, then the offshore fund will not be regarded as a resident for tax purposes. And only the fund manager will be deemed as a resident and his income will be subject to tax. Typically, if you look at the Indian context as far as offshore funds are concerned, they would be more or less similar to that of a mutual funds which operate outside India. They pull in funds from investors, global investors, and invariably offshore funds are located in jurisdictions which are not very tax or regulatory heavy. One is about the rate of tax, second is about the extent of compliance, and there is an entity which will sit and manage this company, which is called as the Offshore Fund Management Enterprise. Offshore funds are reluctant to employ an Indian entity for fund management because, as per the existing laws, it would create the fund to be a resident of India and then its income gets taxed in India. And Indian tax rates are definitely not the lowest in the world. And to ensure that the government figures a way to attract these funds to India, Section 9A was introduced. So, what does 9A say? It says certain activities would not constitute a business connection in India. I just quickly look at Section 9, friends. If you look at Section 9, which talks about income accruing or arising in India, they've given criterion for different heads of income. For salary, the service must be generated out of India. For house property, the property has to be India. Similarly, for business income, the criterion is that a business connection should be out of India. There must be a business connection out of India. Now, Section 9A was introduced to categorically state that a business connection will not arise if for an offshore fund management, provided certain conditions are satisfied. What is that? In the case of an eligible investment fund, the fund management activity carried out through an eligible fund manager acting on behalf of such a fund shall not constitute business connection in India. So, if the fund manager is in India and does fund management activity of an eligible fund, then the fund manager will not create a business connection. And an eligible investment fund shall not be deemed as a resident of India, it would still be deemed as a non resident. Now, if you look at Section 9, as we saw earlier, 9 talks about two criterion. One is if there's a person acting on behalf of a non resident, then that person creates a business connection, or if there is significant economic presence, then again it creates a non-resident I mean, an income accruing or arising in India. Now, some of the critical definitions which we need to understand before we get into the conditions are: one, associate means an entity in which a director, trustee, partner, member, or fund manager, or a director, trustee, partner, or member of the fund manager or the investment fund either holds 15% directly or indirectly. Collectively, they hold 15% of the capital or interest. And corpus is nothing but the total value of funds raised from the funds raised by the enterprise. Connected person, any relative for an individual company, its director and relative of such director, member or partner for firms AOP and BOI. And as far as HUF is concerned, it's any relative of the HUF. Now let's look at the definition of the term eligible investment fund, which is actually made it a put off for such people to set up shop in India. What are the criterions for an eligible investment fund? The fund is not a person resident in India. I mean, it means a fund which is established and which collects from its members for investing it for the benefit and fulfills the following criterion. The fund is a resident of the country or a territory with which India has entered into a DTA, or is established or registered in a country which is notified by central government. The aggregate direct or indirect participation or investment of Indian residents in the fund does not exceed 5%. The fund and its activities are subject to applicable investor protection regulations in the country or specified territory wherever it is incorporated. It has a minimum of 25 members who are directly or indirectly not connected persons. Any member of the fund with connected person, along with connected person, shall not have a participation in interest exceeding 10%. The aggregate participation, directly or indirectly, of 10 or less members with their connected person shall be less than 50%. I mean, from a practical, the fund shall not invest more than 20% of its corpus in any entity. It shall not make any investment in its associate entity. The average monthly value of the corpus of the fund should be 100 crores. And if the fund is established or incorporated in the previous year, the corpus of 100 crores should be reached within 6 months. And minimum corpus shall not apply if the fund is wound up in that year. It shall not carry on or control any or manage directly or indirectly any business in India. The fund is neither engaged in any activity which constitutes a business connection, nor as any person acting on its behalf whose activities constitute a business connection other than the activities undertaken by the eligible fund manager. And the recent amendment is: the remuneration paid by the fund to an eligible fund manager in respect of fund management activity undertaken by him on its behalf is not less than the amount calculated in such manner as may be prescribed by rules or notifications. Now, look at it, friends. From a practical standpoint, it literally makes it improbable for any fund to even look at India as an option if we are going to have 13 conditions like this. And looking at number of members, maximum holding with their related enterprises or associated enterprises, you cannot hold more than 10%, more than 20% in any entity. Now look at it automatically. Let's say if that entity gets into has become a default, there is a convertible note, you will end up violating this 20% cross. So how can a fund manager even predict a scenario like this at the time of beginning the investment? So, which is why 9A has not been very popular. We still haven't gone too far ahead as far as this particular regulation is concerned. But yes, one thing good is some of the policy makers are aware of this lacuna and they're trying to fix this loophole, make it a lot more friendly. The eligible fund manager, who is an eligible fund manager, is not an employee of the eligible fund or connected person of the fund. The person is registered as a fund manager or an investment advisor in accordance with SEBI Portfolio Management and Investment Advisors Regulation. And the person is acting in the ordinary course of business. He, along with connected persons, is not entitled directly or indirectly to more than 20% of the profits accruing or arising to the eligible fund from the transaction carried out by the fund through the fund manager. Now, If you look at global peers in this regard, be it UK or Singapore, they have very, very simple four or three or four conditions or five conditions. India has kept 17 conditions, 13 for the fund and 4 for the fund manager, making it literally unviable and scary for anyone to even start looking at India as an option for fund management. We hope sanity prevails in the coming budget to change this or make this a lot more easier, not more than 4 or 5 conditions. By virtue of this section, income of the eligible investment fund, which would have been earned even without the fund management activity, with the eligible fund manager shall not be excluded from taxation. The provisions of this section shall not have any effect on the scope of total income determination, and the eligible fund shall furnish Form 3C EK within 90 days. Remuneration to the fund manager post amendment. Prior to that, it shall not be less than the arm's length price. Now, what is arm's length price? No one knows. Because how will you benchmark the fund's remuneration paid by a fund manager? Invariably, these are private entities. Most of them are outside India. The remuneration paid by the fund to an eligible fund manager in respect of fund management activity undertaken by him is not less than the amount calculated as may be prescribed, and we expect a similar rule 11 UA to be applicable to be introduced in this regard. Now look at it. Guidance on determination of arm's length price remuneration to fund manager. This is very interesting. Income tax provision shall apply as if the transaction between the fund and the manager is an international transaction. Eligible fund manager and the fund are associate enterprise, therefore transfer pricing would apply. And the fund manager shall keep and maintain transfer pricing documentation. In addition to TP report, the fund manager shall obtain a report from an accountant in respect of activity undertaken by the fund. If the documentation has not been maintained by the fund manager, the AO or the TPO can go ahead and determine the requirement. So technically, the conversation is the fund manager, even though he is in India, the fund is abroad. He does not create, he does not become a PE or a business connection of the fund in India. However, they both are related enterprises. Therefore, the transaction has to be available on the basis of has to be done on the basis of arm's length pricing. The benefits of 9A shall not be denied if the if the ALP criterion is not fulfilled. This shall, however, not be applicable if the remuneration is not at ALP for 3 consecutive years or 3 out of any 4 previous years. If you continue to violate this criterion, then obviously your relief of 9A shall not be applicable to the SC. What are the proposed rules? So sub rule 5 to 10 shall not apply. So the amount of remuneration. So we've got the CBDT notification on 5th of December, which is anyway put up for public notification, public consultation. Category 1 for FPI, 0.5% of AUM, and any other case, 0.3% of AUM or 10% of profits in excess of the specified hurdle rate, or 50% management fee, whether fixed or profit linked, received by the fund as reduced by the operational expenses, including distributional expenses, if any. So the hurdle rate is what has been agreed between the fund and the fund manager. This looks more practical. Definitely, a lot of good sense has prevailed before bringing up this regulation. Let's hope what the ultimate outcome is. And what is an AUM? It means the average annual average monthly annual average of the monthly average of the opening and closing balances. And the fund manager shall submit a report in Form 3CEJA and all other provisions of Section 90. And it shall, and the report is to be furnished under Section 92E. That is a report for the section for 3CEB as well. And this is the form which is required, friends, to be certified by a chartered accountant. Now, so this is as far as Section 9A is concerned and what was the relief the government intended to make it available. Now let's try and understand where India is. Now, India, there has been a lot of hype about this $5 trillion economy and all those things. So what happened sometime in the month of October, a high-level advisory group was created under the guidance of Mr. Surjit Balla, and they came up with a report on a very critical report on why certain certain sectors are not the way they're supposed to. So 22 sectors have been identified as champion sectors, and financial services is also one of those champion sectors. If you notice, friends, India has a $373 million trade deficit, meaning the imports are still more than the exports. As far as financial services sector is concerned, India is still a net importer. Financial service exports have averaged about 5.2 billion in the recent years, while their share in the total service exports has declined from 5.2 to 2.6, literally half over the last 7 8 years. I mean, I think it's a Vodafone effect, I guess. So the focus is more about import substitution and improving skill sets. So the government has looked at the asset management industry, the portfolio management services, the alternate investment funds, increasing tenfolds over the next few years. And India still accounts for less than 1% of the global asset management industry. That's a complete shame. In the case of offshore fund management, most of the offshore investments which come into India, they come in via, which we call as a foreign portfolio investment route. They come into India via Singapore, Mauritius, Luxembourg, Ireland, Hong Kong, and London, where the funds are pooled, and from there they are brought into India. The fund managers also sit outside India. Such funds, only India dedicated funds, friends, about $31 billion of AUM as of 2017, and the regional and global diversified funds which have partial allocation to India have come from these locations. So the thought process is, why can't we make India not only a place for India centric funds but also for global funds which can set up their shop in India. But with those 17 conditions, we are never going to go anywhere close to that. What is the potential? We can create a hub for asset management in India, where at least 7,500 highly skilled finance professionals would be required to work. The management fee earned consequent to this has a propensity to reach up to $1.4 billion in 2025. And tax revenues alone from these fund managers can go up to 3,000 crores by 2025. So, this is the vision, friends. One is, what is good is this industry is now within the radar of the ministry to promote. So, what are the challenges which the industry now faces for setting up offshore funds in India? The eligibility criterion, as we saw, are extremely stringent, and most offshore funds are not able to fulfill those criterion. And there is an remuneration structure, conditions pertaining to remuneration are also impractical in nature, and dual compliance burden for the offshore investor, since they are required to comply with SEBI, RBI guidelines, and now also under income tax. So it makes the whole scenario not very pleasant for an investor and a fund to operate. So I gave you the background of the high level advisory group which presented this report. Um, some of the recommendations: foreign investor entity, which is AIF, alternate investment fund, foreign institutional investor or pension fund, has to be registered with the home country regulator, and there is no requirement for for the regulator to be present, for the entity to be present in the home country, in both the countries, be it India or abroad. See, currently, if you notice, even for income tax, the fund has to be registered in the home country as well as in India, which makes it very difficult. The fund manager should be free to operate from any physical location as long as the entity is registered with a regulator who is an IOSCO, the International Organization of Securities Commission member, with whom of which SEBI is also a member. And the fund and the fund manager should be fully KYC compliant in home country and SEBI, and should have a PAN. I think if these criteria are met, the fund should be allowed to operate. So this is the recommendation. Imagine out of 17 conditions, they have just drilled it down to 4 conditions. So if it gets to this level, definitely this will be a significant boost for this industry. And the entity should be entitled to tax relief. The fund manager are registered with SEBI and comply with SEBI mandate. CA certificate should be made mandatory. There should not be bureaucratic delays, time bound clearances of KYC. SEBI should act as a centralized agency for non compliance and violations. And foreign individual investors should be allowed to invest in India through permitted Indian and foreign banks with simplified PAN process. So these are the procedural expectations. So by and large, what they're trying to say is bring down the criterion to make this provision valid or relevant. Otherwise, this will be only a pro section inside the act with very, very limited. I don't foresee anyone in their right senses ever taking up a benefit under Section 9A. Very, very rare cases, personally. So these are the members of IOSCO, so which is more like a body for securities regulator, security regulators globally. So even though the tax incentives via exemption from residency is provided, there are several conditions making it unviable. The prescription of minimum remuneration is another concerning provision, because you would notice whenever a fund manager is starting a new fund, the first few years or for the first fund, he will be okay to go with very little remuneration or without remuneration as well. Increase in compliance under income tax is only going to increase the overall burden. And considering the relevance of this sector to the economy, the government has to do something to make it competitive for funds to look at India as a serious place to have their shop. So these were some of the thoughts, friends, on this fairly interesting conversation. See you again next week on a topic of relevance. Thank you.